Recently, a viewer asked me a question about home affordability that I could not immediately answer. He acknowledged that home prices and mortgage interest rates were rising, but he was curious if inflation would bring back home affordability in line. What a great question! In fact, if you happen to have a great real estate question, please share it with me in the comments section below. If I think it fits within this channel's scope, you'll probably hear me address it soon. So back to his question, which I will summarize as, are wages keeping up with rising home costs? Now, longtime viewers know that I've warned of declining home affordability and even adjusted monthly mortgage payments with inflation, but I've never done so with wage inflation. Today, I'll take you through the data required to answer this important question. I've produced an analysis that examines the cost of buying and owning a home today compared to the past 45 years by adjusting monthly mortgage payments with wage inflation data. I discovered wages have risen, but have they risen as fast as home prices and mortgage interest rates? Follow along with me through this short video. You might be surprised with the answer. I have included 6 graphs for sequential validation that I quickly cover today. If I move on from one too fast before you've been able to fully digest its message, you can jump back to it by using the links to each graph that are included below. Our first graph plots the U.S. median home price each quarter from January 1987 through June 2022. The fact that home prices are rising is not newsworthy, but a picture of the growth they have undergone is enough to take your breath away. Through June, the median U.S. home price was $440,000, a rise of more than 15% from a year ago when the median home price was just $382,000. As I have addressed in numerous other reports, the U.S. has not been producing enough new homes to house its growing population. This is confirmed with both home prices and rents soaring due to the limited supply of homes. Rising prices is one major factor in the decline of home affordability, and the next graph shows us the double whammy second factor that is hurting home affordability too. This graph plots the 30-year fixed mortgage interest rate for the past 50-plus years. A cursory examination shows that today's rate is still well below the 50-year average. Unfortunately, while rates are still relatively low, they are now more than double the 1 year ago rate. This has created sticker shock in the housing market and home sales have tumbled. Take a close look at the long-term trend. Generally speaking, we've enjoyed declining rates since the 1980s, which has been a huge boon to the home affordability. There are several generations of Americans who have purchased homes and refinanced them over the years to obtain cash for living expenses. This will not be so prevalent in the future with rising mortgage interest rates. Additionally, we have seen generations of move-up buyers who are able to use the equity generated from their homes combined with lower mortgage interest rates to buy superior homes. With rates having hit all-time lows last year, it might be a long time before the move-up buyer market returns in force. This graph shows how both rising prices and rising mortgage interest rates have impacted the monthly mortgage payment a median homeowner is making. The median home price is plotted in blue and reported on the left vertical axis, while the monthly mortgage payment is green and reported on the right vertical axis. The median monthly mortgage payment has grown 233% since 1987, from $750 to over $2,500 per month. More importantly, much of that growth has occurred in just the past 2 years. If you are a longtime subscriber, then you know I discuss declining home affordability all the time because I believe it's the most important topic in housing, and I don't think the mainstream media nor politicians give it enough attention. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all of my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts and ignore the hype that is so prevalent online, then subscribe now and I'll keep you in the know. U.S. wage inflation is accelerating. This graph plots the U.S. wage inflation since 1987. Specifically, it reports the Consumer Price Index for all urban wage earners and clerical workers. It is one thing to say that mortgage payments have grown, but inflation has caused the price of everything to grow. Note how sharply wages have turned higher in the past 2 years. We can use the information in this graph to compare how mortgage payments have moved relative to wages. We know people are earning more and spending more, but are earnings or costs prevailing for their housing budgets? Our next graph reveals the effective growth rate of mortgage payments since 1987. This graph, similar to the previous graph, plots the median home price and the median monthly mortgage payment and adds the wage inflation adjusted median monthly mortgage payment. When adjusted with the Consumer Price Index for all wage earners, the monthly mortgage payment, the red line, is far less extreme than the unadjusted payments. Let's zoom in on the adjusted payment to see it more clearly. The final graph in our report shows how the wage-adjusted monthly mortgage payment has changed since 1987. When adjusted as we have done in this graph, the monthly mortgage payment is represented in 1987 dollars. Surprisingly, today's crazy high mortgage payments have not yet established a new high. Payments from 1988 through 1990 were often higher than today's payments. What I find most interesting is just how low wage-adjusted mortgage payments dropped at the end of 2011. In November of 2011, the wage-adjusted mortgage payment was less than 1/2 of the high reached in 1988. This reminds us how good the housing market has been recently, so we should expect tougher times ahead. So here's the big question: are wages keeping up with the cost of housing? Based on the data explored today, it's clear that wages have kept up with soaring prices in the housing market. Monthly mortgage payments today are consistent with payments 35 years ago and are only slightly higher than payments 15 years ago. One could argue that we've had it really good of late, but will this trend continue? I believe that it will, but things are going to get worse before they get better. We should all brace for rising mortgage interest rates. The Fed has made it clear that they are expecting to raise the Fed funds rate several more times to curb inflation. This means that today's shocking home affordability levels are likely to be better than what buyers will face in 2023. As far as wages go, it's a variable outside of my normal field of study. I can provide anecdotal evidence as a small business owner that I'm seeing wages much higher today than what we saw just 2 years ago. Starting salaries are far higher, pushing all salaries northward as well. When you consider that many states have increased their minimum wage levels at rates far higher than the historical norm, I believe you should expect to see continued acceleration in wage growth. How the Fed reins in inflation without trumping wage inflation is the million-dollar question. The effectiveness of the Fed's strategy over the next 5 years will have a great impact on home affordability in the years to come. Keep checking back with us from time to time, and we'll keep you in the know for housing. If you want to see a video featuring my 9 tips for buying a home in a highly competitive market, you can view it by clicking on the box in the top left corner of your screen. To see a popular video featuring my top 6 home selling tips, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.